Imagine a young professional in Shanghai who proudly buys a shiny new electric car, only to find a few months later that the same model now sells for 20% less. In early 2024, a 22-year-old Chinese paid 94,800 yuan, about $13,000, for a BYD Qin Plus plug-in hybrid sedan, a popular and affordable choice. 4 months later, its price had dropped by 15,000 yuan. "I feel like I was scammed out of 15,000 yuan, she lamented, seeing more than 3 months' salary vanish in an instant. Her story is not unique. Across China, EV buyers have watched the value of their cars plummet weeks or even days after purchase as automakers slash prices in an escalating price war. On Chinese social media, new car owners joke darkly about being stabbed in the back by sudden price cuts. Small-scale protests have even erupted, a rarity in China, such as when Tesla buyers gathered at showrooms in early 2023 to demand refunds after the company's surprise discounts. What is going on in the world's largest electric vehicle market? How did intense competition and relentless discounting turn a once promising industry into a financial sinkhole? China's electric vehicle boom did not happen by accident. It was engineered through deliberate policy and massive investment. Rewind to the late 2000s. The Chinese government, eager to combat urban pollution and reduce dependence on imported oil, identified new energy vehicles, NEVs, as a strategic industry. In 2009, Beijing launched its 10 cities, 1,000 vehicles pilot program, rolling out purchase subsidies, tax breaks, and R&D support to jumpstart electric car adoption. Over the next decade and a half, the state poured extraordinary resources into the EV sector. By one estimate, China's government support for its EV industry totaled roughly $230 to $231 billion from 2009 to 2023. This included consumer purchase incentives, grants to manufacturers, cheap land for factories, and huge low-interest loans from state banks and local government financing arms. The public purse essentially absorbed the early losses of EV production, allowing dozens of domestic companies to survive and scale. This top-down industrial policy spurred a meteoric rise in China's auto industry. China went from having under 10 million passenger cars on the road in 2001 to becoming the world's largest car market by 2009. In the process, foreign automakers entering China were required to form joint ventures with local firms, helping Chinese companies acquire technology and expertise. When electric vehicles arrived on the scene, China was determined not to miss the opportunity. Generous subsidies and protective policies cultivated a vibrant yet crowded EV ecosystem. By 2019, the number of registered EV manufacturers in China had ballooned to 486 companies. These ranged from state-owned giants and tech conglomerate offshoots to scrappy startups. Internet and electronics firms, from Alibaba to Xiaomi, as well as property developers, jumped on the EV bandwagon, seeing it as a safe bet after crackdowns hit other industries. For a time, capital was plentiful and optimism ran high. The strategy delivered results in sheer output. China built not only car assembly plants, but also the world's largest supply chain for EV components, from batteries to electric motors. By the early 2020s, Chinese companies like CATL dominated global battery production, and dozens of domestic EV brands were on the market. China now accounts for nearly 2/3 of global electric vehicle sales. In 2024 alone, over 11 million electric cars, battery electric and plug-in hybrids, were sold in China. Almost half of all cars sold domestically that year, and more than the rest of the world's EV sales combined. Chinese automakers from Aion to Xpeng have emerged as innovators, rolling out models with cutting-edge features like battery swapping, in-car AI assistance, and advanced driver aids. NIO, founded in 2014, popularized battery swapping stations and claims the world's longest-range EV battery. BYD, originally a battery maker, became the world's top EV seller, outselling Tesla globally in early 2024. BYD delivered 416,000 EVs in the first quarter of 2024 versus Tesla's 336,000. As of 2023, over 200 different EV models were available in China's hyper-competitive market. This boom has been a cornerstone of China's manufacturing and tech rise. It has also been a point of national pride. The government's push created several domestic champions and reduced the historical reliance on foreign automakers. By 2023, homegrown brands dominated China's EV sales charts, and foreign joint ventures like Volkswagen and GM were scrambling to catch up in the electric race. China even became a net exporter of cars for the first time, shipping 4.9 million vehicles overseas in 2024, a nearly 20% jump from the previous year. Chinese EVs began appearing on the streets of Europe, Southeast Asia, and the Middle East, often boasting unbeatable price-to-feature ratios. All seemed to indicate that China was on the verge of owning the future of mobility. Yet, underneath the headline numbers of skyrocketing sales and global expansion, cracks in the foundation were forming. The EV boom, while impressive in scale, had been built on volume, not profit. Most Chinese automakers were selling lots of cars but earning little to no money on them. Generous subsidies and easy financing masked this reality for years. But as the industry grew more crowded and the government started tapering direct subsidies, China's national EV purchase subsidies officially ended in 2022. The true economics began to bite. By 2022 to 2023, China's EV sector was a crowded battlefield, and storm clouds were gathering. The stage was set for a fierce shakeout. The trigger for the EV price war can be traced to a confluence of events around 2023. Growth in China's auto market was slowing overall as the post-pandemic economic rebound lost steam. At the same time, dozens of EV makers, from established players to startups, were desperate to expand their market share and unload growing inventories. When Tesla, the high-profile foreign competitor, slashed prices on its Model 3 and Model Y in China in early 2023, it sent a shockwave through the industry. Tesla's cuts, up to 13% off in January 2023, made its locally produced models much cheaper relative to Chinese rivals, forcing others to respond. Soon, a cascade of discounts and promotions spread across the market. By the spring of 2023, almost every major automaker in China was offering deals. Some offered free charging credits or big trade-in subsidies, while others directly cut sticker prices by thousands of yuan. At the 2023 Shanghai Auto Show, the competition was so intense that executives openly talked about a price war threatening everyone's margins. Chinese authorities grew anxious as this frenzy threatened to spiral. In July 2023, 16 automakers, including Tesla and Chinese EV leaders NIO, Li Auto, and Xpeng, publicly pledged to avoid abnormal pricing and not pursue further steep cuts. Observers saw this as a potential truce in the price war. However, the truce collapsed almost immediately. China's anti-monopoly regulators intervened, warning that an industry-wide agreement on pricing could itself violate antitrust law. The Auto Association hastily retracted the pledge just 2 days later, and the price war resumed in earnest. In effect, the government signaled that while it disliked the chaotic competition, it couldn't explicitly allow collusion to stop it. Without a coordinated ceasefire, companies reverted to open rivalry. Throughout 2023 and 2024, waves of price cuts continued to wash over the market. A telling example came in February 2024 when BYD, China's top-selling EV brand with 2.4 million sales in 2023, announced price reductions across almost its entire lineup. It even launched a new plug-in hybrid model at just 79,800 yuan, around $11,000, under the slogan, "Batteries are cheaper than engines." Competing brands had little choice but to follow. Over 10 other EV makers cut prices around the same time. Tesla, never one to be undercut, rolled out fresh incentives and referral discounts globally. The result was a downward spiral, a race to the bottom in pricing. By late 2024, the average selling price of battery electric cars in China had fallen by 14% year-on-year. Some budget EV models were so cheap that a new electric car in China could cost less than a basic subcompact gasoline car in the US. For perspective, models like the Wuling Mini EV, a tiny city car, sell for under $5,000, and even larger sedans like the BYD Seagull have been offered for just 55,800 yuan, or about $7,800. While consumers initially cheered lower prices, the relentless cuts began to sow confusion and resentment. Many potential buyers adopted a wait-and-see attitude, expecting next month's deals to be even better. Why rush to buy today if the price might drop tomorrow? This dynamic put further pressure on automakers, who found inventories piling up as buyers delayed purchases. And those who had recently bought at higher prices felt burned, as we saw with unhappy BYD and Tesla owners. Thousands of complaints flooded consumer hotlines about sudden price changes. Some 6,884 formal complaints were logged in early 2023 regarding EV price drops, making up nearly half of all auto-related complaints in that period. In online forums, Chinese car buyers vented about losing significant money on depreciated cars and banded together demanding compensation. The trust between car companies and customers was getting eroded by the volatility. The price war was not just a battle of prices, but a battle of endurance. Smaller and weaker companies soon began to falter. Selling cars at razor-thin or negative profit margins is not sustainable, especially for startups without other revenue streams. By 2024, a number of China's EV startups started running out of cash. WM Motor, backed by Baidu, and iWays, backed by Tencent, once promising new entrants, were effectively bankrupt by 2023. Hi-Fi, a maker of flashy luxury EVs with features like built-in refrigerators, struggled to sell a few thousand units a year and hit a financial wall. Levdeo and Singulato, other EV makers, entered bankruptcy proceedings. The shakeout had begun. In fact, for the first time in modern memory, more Chinese NEV brands exited the market than entered in 2024. The total count of active EV manufacturers in China shrank dramatically, from the peak of 486 in 2019 down to roughly 100 by 2023. A consulting firm, Alex Partners, predicted that only 25 to 30 out of over 160 Chinese electric car brands will likely survive through 2030, with the rest consolidating or disappearing. In short, the industry is entering a Darwinian phase. Even the market leader, BYD, often seen as the instigator of aggressive price cuts, has not been spared from collateral damage. In late May 2025, BYD launched another round of steep discounts, 10% to 30% off various models, pricing some popular EVs under 150,000 yuan, $20,000, and dropping the Mini Seagull EV to 55,800 yuan, down from its 69,800 list price yuan. This bold move sent shockwaves. Within weeks, BYD's stock price tumbled, wiping out roughly $22 billion in market value. Investors were spooked that even the strongest player was slashing into its margins to grab share. BYD's executive vice president Stella Li openly acknowledged that the very extreme tough competition is not sustainable. She predicted imminent consolidation among major Chinese car makers as an inevitable outcome. In other words, even the winner of the price war knows it can't go on forever. Chinese authorities, too, have ramped up their warnings. In June 2025, government officials summoned auto executives for a meeting, urging them to stop the disorderly price wars and exercise self-restraint. The state media has chimed in. The Ministry of Industry and Information Technology, MIIT, issued guidelines asking firms to avoid vicious competition. People's Daily, the Communist Party's flagship newspaper, ran a commentary that price wars would ultimately hurt consumers. By forcing automakers to use cheaper parts, cut corners on service, and slash R&D spending, which could drive automakers to use low-quality parts, reduce after-sales service, and cut research and development. Premier Li Qiang even described the situation with a buzzword: involutionary competition, a futile, self-defeating rat race where everyone works harder for small gains. In short, Beijing is deeply concerned that its EV crown jewel is devolving into chaos. All this ruthless competition might be celebrated if it simply weeded out inefficiency and delivered great deals to consumers. But the financial strain it's causing across the industry is alarming. Profit margins have collapsed. On average, Chinese automakers' net profit margin fell to just 4.3% in 2024, down from about 5% in 2023. For context, 4 to 5% net margin is only a slim buffer against losses, and that's an average. Many firms are in the red. The contrast with global peers is stark. Toyota Motor Corporation made $32 billion in profit in fiscal 2023, a record high. Yet in the same year, the combined net profits of China's 5 largest listed car makers, BYD, Geely, Great Wall Motor, Li Auto, and SAIC, added up to only about $11 billion. In other words, all 5 Chinese giants together earned barely 1/3 of Toyota's profit. BYD, the biggest of them, made $5.6 billion net in 2024. Others were far behind. Geely earned 16.6 billion yuan, Great Wall 12.7 billion yuan, Li Auto 8.0 billion yuan, and SAIC a mere 1.7 billion yuan. Astonishingly, SAIC Motor, a state-run behemoth and long-time Shanghai auto champion, saw its profit plummet 88% in 2024 to just 1.7 billion yuan, and even indicated it would have been loss-making without some one-off gains. The industry's dominance in volume hides how little actual profit, or cash, many firms are generating. Chinese dominance rests on volume, not value, as one analyst put it bluntly. With profits under pressure, companies have been leaning ever more on borrowed money and creative financing to keep the wheels turning. A worrying picture is emerging of an industry loaded with debt and other liabilities, some of it hidden off the balance sheet. One startling warning came from Wei Jianjun, the chairman of Great Wall Motor, one of China's larger automakers. In May 2025, Wei cautioned that an Evergrande of the auto industry could appear, referring to the highly indebted property developer whose collapse shook China's economy. He claimed some car makers are addicted to burning money for market share, overly reliant on external financing while neglecting real innovation. If market conditions change, these firms' capital chains will break, he warned, potentially triggering a debt implosion like Evergrande's. Notably, Wei did not name names, but industry watchers immediately thought of certain EV frontrunners. BYD has come under intense scrutiny in this regard. Officially, BYD's finances appear solid. The company reported a net profit increase of 34% in 2024 and a debt-to-asset ratio around 70%, down slightly from 2023. A 70% debt ratio, meaning debts equal 70% of total assets, is high but not unheard of in the auto industry. It's comparable to GM's 76% or Geely's 68%. BYD's executives bristle at the suggestion that it's over-leveraged, pointing out that Ford's debt ratio is even higher at 84%. However, independent analysts have raised red flags. GMT Research, an accounting consultancy, argued in early 2025 that BYD's real net debt was orders of magnitude higher than reported. The key issue is off-balance sheet debt. BYD has been effectively financing itself by delaying payments to suppliers through complex instruments. BYD runs a supply chain finance platform, Dilink, that allows it to issue notes to suppliers instead of paying cash promptly. Those IOUs can circulate for months. GMT found that BYD's invoices sat unpaid for an average of 275 days, nearly 9 months. If you count those as interest-bearing liabilities, BYD's net debt would jump to 323 billion yuan, about $45 billion, as of mid-2024, versus the official figure of just 27.7 billion yuan. In effect, BYD could be 12 times more indebted than its balance sheet shows. Its net debt-to-equity ratio might be over 200%, which starts to look eerily reminiscent of Evergrande in terms of leverage. Why is this worrying? Because it suggests BYD's aggressive growth, building factories, selling cars at thin margins, extending credit to dealers, has been facilitated by pushing costs down the chain. Many suppliers have apparently been willing to accept BYD's commercial paper in lieu of immediate payment, likely because banks were willing to discount those notes. It's a form of borrowing that doesn't show up as bank loans on BYD's books. But if confidence in BYD wavers, this setup could unravel swiftly. If suppliers start demanding cash, or banks stop accepting BYD's IOUs, the company could face a cash crunch, exactly how Evergrande's crisis began. For now, BYD is still perceived as strong, so this chain financing continues. But the capital chain is stretched taut, and any stress, like lower sales or a credit downgrade, could snap it. BYD is not alone. NIO, often dubbed China's Tesla, has never posted an annual profit since its founding. It nearly ran out of cash in 2020 before being bailed out by municipal government money. In 2024, NIO again needed a rescue. Abu Dhabi's sovereign fund injected $2.2 billion, and the Hefei city government gave another 3.3 billion yuan in low-interest loans to keep NIO going. Xpeng and Li Auto have had to regularly raise funds via stock sales or strategic investors to finance their heavy R&D and expansion costs. Geely, a more established player, did report 16.6 billion yuan profit in 2024, but over half of that came from a one-off asset sale. Its underlying earnings were much weaker. Meanwhile, Seiki and Great Wall, which earn more from gasoline vehicles, have seen profits collapse amid the EV onslaught. All told, China's major automakers are carrying hundreds of billions of yuan in liabilities. The top 20 manufacturers combined had close to 900 billion yuan, approximately $125 billion, in liabilities by 2024. And this debt is being serviced by what one might call hope and thin air. Extremely low margins and the implicit expectation of government support if things go south. Credit rating agencies know that outright bond defaults by state-linked automakers are unlikely. Instead, they worry about soft default scenarios where companies quietly extend payables, delay paying suppliers as we saw, to cope. Indeed, the Chinese government in March 2025 implemented a new regulation requiring companies to pay suppliers within 60 days, effective June 1, 2025. This was partly to address growing complaints from small suppliers and to improve transparency. BYD immediately said it would comply and standardize payments to 60 days. But analysts note, once such rules force companies to bring those hidden IOUs onto their books, many automakers' debt ratios will visibly jump in late 2025. Another repercussion of the price war is the squeeze on auto dealerships. In China, many car dealers take on inventory and floor plan loans. When automakers slash prices, dealers can be left holding high-cost inventory that they must now sell at a loss. Reports suggest a number of BYD-affiliated dealerships shut down between April and June 2025, unable to cope with the sudden margin hit. This is a reminder that the pain propagates beyond manufacturers. Suppliers, dealers, and other downstream players are all feeling the strain. The ultimate fear is that a major EV company could collapse financially, sending shockwaves through the economy. If a large automaker failed, it would mean massive job losses, given the millions employed in factories and supply chains. The bankruptcy of any large auto firm would result in many people losing their jobs, harm upstream and downstream companies, and negatively impact the Chinese economy, Wei Jianjun warned. He estimated one big failure could be as damaging as Evergrande's implosion in real estate. China's EV industry directly accounts for roughly 2 to 4% of GDP and supports 8 to 10 million jobs, including suppliers and logistics. A disorderly contraction would hit industrial output, banks, and local governments all at once. S&P Global analysts calculated that a 30% cut in EV production, for example, if several big firms drastically curtail output to survive, could shave 0.8 to 1.2 percentage points off China's GDP growth in 2025. Banks could see a spike in non-performing loans from auto sector borrowers, denting profits by an estimated 4 to 5% for listed banks. And provinces that rely on auto manufacturing, places like Anhui or Jiangxi, would lose significant tax revenue, worsening the local government debt woes that already exist. Chinese regulators are keenly aware of these risks. That's why, even as they urge market discipline, they quietly prepare to intervene if needed. Beijing has tools to prevent an outright collapse. State banks can extend credit to troubled firms, local governments can orchestrate mergers or bailouts, and policymakers can roll out incentives, like temporary tax breaks or subsidies, to boost sales if things get dire. Indeed, in late 2024, the government did introduce new tax incentives and extended EV purchase tax exemptions to prop up demand. However, each intervention comes at a cost. Economists note that transferring the auto sector's problems onto government balance sheets would add to China's already large contingent liabilities, debts lurking in state-backed firms and local financing vehicles. Moody's has cited these concerns in assigning a negative outlook to China's sovereign credit, worrying about the growing burden of bailouts. In short, if the EV war triggers a rescue, it could morph from a corporate debt issue into a public debt issue. The turmoil in China's EV sector is reverberating beyond just balance sheets. It's affecting consumers, technological progress, and even the global auto landscape. One immediate consequence of the fierce competition is overcapacity. Factories are churning out more cars than can be sold. In fact, in 2024, China's auto industry used less than half, 49.5%, of its production capacity on average. Imagine assembly lines and suppliers operating at barely half speed. That's a lot of idle resources, which equates to wasted money. By comparison, in 2017, the utilization rate was nearly 85%. The plunge to 65% by early 2024, and even lower industry-wide by year-end, tells a story of too many factories and not enough buyers at current prices. Overcapacity is a classic precursor to price wars. Every company tries to keep its plants running by undercutting others, which leads to a race to the bottom in pricing. It becomes a vicious cycle. Oversupply leads to discounts, which train consumers to wait or expect lower prices, which then exacerbates oversupply as sales slow further. Another knock-on effect is on consumer behavior and brand perception. The Fortune analysis of this situation argued that constantly plunging prices have been distorting consumer behavior, threatening long-term trust in brands. When buyers come to believe a car will be cheaper next month, or suspect the quality is compromised to cut costs, it undermines the industry's credibility. There is anecdotal evidence that some consumers are losing confidence. For instance, some EV owners worry about whether bankrupt brands will continue to provide software updates or parts support. In one case, owners of WM Motorcars, from a now insolvent startup, reported glitchy software and had nowhere to turn for fixes. As one observer noted, an electric car is heavily software-driven, and if the maker goes bust, it's often unclear who takes care of the software, potentially leaving customers with a bricked vehicle over time. Such stories, if they proliferate, could make buyers more cautious about choosing lesser-known brands, accelerating the shakeout of weaker players. Quality and innovation may also suffer when margins are squeezed. Automakers under severe financial strain might cut back on customer service, as People's Daily warned. They might also skimp on components, using cheaper materials that could affect reliability. In the longer run, sustained price pressure could force companies to slash R&D budgets, imperiling the technological advances that helped Chinese EVs leap ahead. Some industry insiders fear that if the price war continues unabated, China's EV makers could fall behind in the next generation of improvements, like autonomous driving software or high-end chips, because they simply aren't investing enough in research while fighting for survival. The Chinese government certainly doesn't want its EV champions to end up producing low-margin, low-quality lemons. After all, the EV industry isn't just an economic play. It's linked to national strategic goals like technological self-reliance and clean energy leadership. Hence the balancing act. Allow competition to push out the weakest, but not so much carnage that the whole sector loses momentum or tarnishes its reputation. Internationally, China's EV price war is creating global ripple effects. For one, Chinese automakers are increasingly looking overseas to compensate for the tough fight at home. Exports of Chinese cars, many of them electric, have surged, making China the world's largest auto exporter in 2023 to 2024. Companies like BYD, SAIC, with its MG brand, and Great Wall are shipping EVs to Europe, Southeast Asia, Latin America, and beyond. In Europe, Chinese EV sales are rising rapidly, aided by their lower costs. In May 2025, BYD actually outsold Tesla in Europe for the month, after its sales jumped 169% compared to a year prior, while Tesla's European sales fell. Chinese models often sell for significantly less than comparable European or American models, sometimes even cheaper than the lowest-cost gasoline cars in Western markets. This is great for budget-conscious consumers abroad, but it's raising alarm bells among foreign automakers and policymakers. Trade tensions are brewing as a result. The European Union launched an anti-subsidy investigation into Chinese EV imports in late 2023, arguing that China's state support allows unfair undercutting of European manufacturers. By October 2024, the EU had imposed provisional tariffs ranging roughly from 17% to 35% on Chinese EVs to protect its market. BYD's models got a 17% duty, Geely's 18.8%, and some others 35% plus. China, in turn, protested and even suggested setting minimum export prices for its EVs to Europe to avoid triggering more tariffs. A trade spat is unfolding. Beijing retaliated by imposing tariffs on European goods like luxury wines and cars, indicating it won't sit idle. Other countries are also wary. The United States has effectively shut out Chinese EVs with sky-high tariffs, import duties of 100% or more, and US tax credits explicitly favor North American-made EVs. India has delayed and limited Chinese automakers' entry, citing localization rules and security concerns. Japan and South Korea, home to Toyota, Hyundai, etc., are cautious on Chinese car imports as well. So, Chinese EV makers cannot simply export their oversupply freely to all markets. They face protectionism abroad just as they face cutthroat competition at home. This limits their escape valve. For instance, exports to developing markets, like Southeast Asia, Middle East, South America, are growing, but those markets are smaller and often price-sensitive. In developed markets, Chinese EVs are making some headway in Europe, but Europe's stance is hardening to defend its own industry. In short, Chinese firms are somewhat constrained in selling their way out of trouble via exports because geopolitics and trade barriers stand in the way.